going off during the session. I'm going to come back at the end with a performance card for each of you. Just bear that in mind. Always going to ask me, so just prepare to act, okay?
Real live on YouTube now.
Thanks, everyone. You're in the right place. This is indeed the webinar on how US corporations are meeting sustainability goals through public bond markets, but people are slowly registering. It'll take a couple of minutes for that little number at the bottom of the participants to climb up, and I'll get going once I've got a slightly larger crowd registered. We have another 100 or so people registered, so I'll start in just a minute. This session will be recorded and will be available on YouTube after this particular event. Should you find interesting enough to share with your colleagues, please do. There's a fantastic set of panelists today, but I'll let our moderator, Aude Rajanson, introduce them in a minute once she gets going. I'm going to say a few words once we get started officially, once our producer tells us there's a green light and we're ready to go. Letitia, that's you over in Brazil.
I think we're good to go, Sean.
Okay. Folks, I'm Sean Kidney. I'm the CEO of the Climate Bonds Initiative. We're a global NGO dedicated to mobilizing capital for climate action. You kind of know what's involved here, right? We've got a bit of a challenge ahead of us. According to the IPCC report, the Intergovernmental Panel on Climate Change, just a few short weeks ago, we need to get emissions down by 50% or 55% globally by 2030 to have even a reasonable chance of avoiding utterly catastrophic climate change. That's the challenge we face. All the world's major economies have now committed to strong 2050, 20 and 2030 goals. That's a huge change in 2 years. What does it mean for investment? What does it mean for the change in government policy? What does it mean for industries and so on? Well, that's the question that everyone's asking in the world I work in around investors going forward. But what we do know, and this is something that every investor I speak to of any large scale says, the shape of the future is decided. It will be clean and green. The question now is the speed of transition and who's going to prosper and who's going to suffer from this transition. Because, you know, transitions are volatile and there's turmoil. It's going to take a lot of work to keep the portfolios going during this phase, to keep our ability to create the kind of wealth that powers our societies, gives people healthcare and gives people jobs going. We have challenges ahead of us. One of the good bits of news we have is that we know what the solutions are. We've got a very clear tableau of solutions we can use right now, not just energy, but transport, in property sector, in agricultural sector. We know. Yes, they are ambitious. We're going to need some significant and drastic changes to drop our emissions down, let alone prepare for the volatility of the 21st century, because we've got climate change, folks. It's a matter of how bad it's going to be now. We're going to need a lot of capital. In a report by McKinsey put out in January this year, they talked about $9.2 trillion US a year required to address the mitigation side of the challenge we face, and more for resilience activities. It's a big capital lump, but we've got a couple of things going for us. One is we now have the largest pool of capital ever in human history on the planet, scattered around the US, Europe, Japan, China. We have the capital. And we know, thanks to the incredible success of the green and sustainable and social bond market, that if we package the capital to meet the risk yield requirements of investors, they will invest in droves. We have seen extraordinary rates of oversubscription over the last few years. You know, the European Commission's 10 billion euros of green bonds, 10 times oversubscribed. 10. The UK government was the same, and that applies to corporates as well. We're seeing pricing differential. We're seeing link between equities prices and bond issuance. Investors are using bond issuance that is green as an indicator that the company is lowering its risk of being affected negatively by the transition, and the stock price goes up and stays up. We have proof, in other words, that the capital will move if we construct the deals. The problem we're dealing with is a lack of deals in the place, a lack of investment opportunities. And that's where our panel is going to be fantastic. On that note, I'd like to turn over to our fabulous moderator, Aude Rajanson from the London Stock Exchange Group and our partner in bringing this webinar to you today. Ord, over to you.
Thank you, Sean, for this great introduction. Very inspirational, as always. I'm Audra Johnson from the London Stock Exchange, and I'm based here in New York. And welcome, everyone. I think, Sean, to your point, it's great to see that we've seen a lot of success on the sustainability bond market. And we have seen green and sustainability debt issuances increasing over the last few years. Looking at data from a London Stock Exchange perspective, the amount of debt issued across green, social, sustainable transition has increased by over 370% from 2019 to 2021, 2021 being a record year for exchange. And 2022 is starting to show a similar trend, which is really encouraging. But if we look closer at the breakdown of volume of issuance, we'll notice that ESG bonds are primarily driven by governments, SSAs, and financial institutions. And corporates are quickly catching up, but only representing 25% of the total volume issued on the sustainability bond market. So what does it mean? It means that we need more corporates to issue sustainability instruments, in particular coming from the US. And this is why today, Sean and I were very delighted to be joined by a fantastic panel of experts that needs no introduction to have a conversation about the journey for corporate treasurers to issue a sustainability bond. You know, what are the different steps? What is the process that corporate treasurers and sustainability officers in the US have to follow? What are the opportunities and challenges that they face? And so for this, I'm delighted to be joined by experts. So Amber Shi, Senior VP at Salesforce Treasury Team, Marilyn Sassy, Managing Director at JP Morgan, Emily Wang, Vice President at BlackRock, Alan Denenberg, Partner at Davis Polk. So we really look forward to making this session as interactive as possible. There will be a Q&A at the end, so I really encourage the audience to ask any questions in the Q&A box. So Amber, so Salesforce last year issued their debut $1 billion sustainability bond to fund social and green project. And you obviously led that project, you led that transaction. So firstly, well done and congratulations. Why don't we start with you then at an issuer? You know, could you maybe start telling us about your journey on the sustainability bond market? How did it start? What was the process like for you internally?
Well, first of all, thank you, Aude and Sean, for that passionate introduction for sustainability. I would like to thank Climate Bond Initiative and London Stock Exchange for hosting this panel. And I'm excited to be here to share our experience. It's not a surprise, our company is very passionate about sustainability. So the idea of issuing a sustainability bond works very well with our corporate values. Our company started our sustainability journey since the inception of our company with our 1-1-1 philanthropic model, which commits 1% of our equity, technology, and employees' time to improving education, equality, and the environment. And at Salesforce, we lead with our values that consist of trust, customer success, innovation, and equality. And our fifth value added this year, sustainability. So the sustainability bond market works really well with our fifth value. We see the role of corporate sustainability is to improve the state of the world by influencing its company's action. Our sustainability vision is to bring the full power of Salesforce to create a sustainable future, net zero, 100% renewable energy, and 1 trillion trees planted. So the first step that we look to starting our sustainability bond is to form a framework. And that starts with getting to know your head of sustainability and know your company's spend. We also began with education from our banks, our banking partners, and peers. Originally, we started with the green bond framework. However, when we began to raise our bond last year, we expanded to also include social spend. Hence, we ended up issuing a sustainability bond. At the start of as part of the process, we identified project categories with meaningful spend that align with the UN SDGs our company supported, and we determined eligible spend and measurable impacts and KPIs. We socialized upward internally and presented the full final framework for our audit committee's approval. And at the same time, we engaged advisors, including a second party opinion provider, sustainability agent, and external auditor. Overall, our process benefited by already having a sustainability team and a published stakeholder impact report for several years. From our corporate treasury experience, we assigned a dedicated person to focus on this project to ensure alignment with all the internal and external stakeholders. And I was very grateful to have an amazing team that worked on this, executing our sustainability bond.
Thank you, Amber. Marilyn, at JP Morgan, you advise a lot of clients like Amber, obviously at Salesforce. So when it comes to funding the sustainability strategy, why choosing the bond market over another funding route, for example? And then in the bond market, there's different type of instruments. How do you make recommendation on which type of ESG bond is best suited for your clients? Marilyn, I think you're on mute.
So sorry. It's a great question. Thank you for asking. I think when we look at the wealth of financial instruments that are available to a corporate treasurer, whether one actually uses a bilateral loan, if you're in the leverage finance space, it might be a term loan B, and if you're in the investment grade, you may see more bond issuance, right? It's really a macroeconomic and more of a, the question does not rely on the sustainability aspects of the transaction. So for the interest of this panel, rather than going through basic bond discussions and those choices, I think it probably is a good use of our time to really talk about the varying instruments and how we think about them. So as Amber said, quite clearly, you need to begin and work together and meet your sustainability team. And then together you look at what you see as past spend. It could look back to up to 2 years. It could be, and then your forward spend over the next couple of years. You begin then to form a list of eligible project categories that will then shape the framework document that your structure works together with you to create. Whether or not you want to do a green bond or a social bond or a sustainability bond will largely depend upon the spend, right? So for many large issuers, such as Salesforce, they have a choice because they have so much, right, that they work on. They could have done a green bond, a social bond, or a sustainability bond. What we found with many corporates in the US is that they like the combination of both green and social projects, that quite often the sustainability office looks at it very holistically rather than just environmental or just social. So you'll notice there's a larger presence of sustainability label being used here in the US. But again, it really comes down to one, what you want to communicate with your ESG issuance, and then of course what your spend will be. The other instrument that is relatively new, it's really largely around for a year or so, and that is an ESG linked bond. And that could be a bond in which a corporate will commit to certain goals that they achieve, what we refer to as KPIs, or key performance indicators. And they will set a self-imposed penalty if they do not achieve the target that they set within a specified amount of time. We've had a few of those transactions here in the US, but they really are quite a lot of global participation. We often tend to see that from the hard to abate sector. So I think that's it. Now on the loan side, we have, of course, term loan Bs, which I mentioned earlier. We have revolving credit facilities that is very popular in the ESG linked format. They can be drawn or undrawn, of course. And we also have, I would say, a bilateral green loan that you could look at, or a social loan. So that's the landscape. And it really depends upon, as I said, the spend that an issuer has and the communication message that they would like to share with their investors.
Emily, it'd be interesting to actually get your perspective as a very active investor in the ESG space. BlackRock, from BlackRock perspective, what is the structure of your ESG fixed income portfolio? And do you, we've heard that there's different types of ESG bonds. Do you tend to invest more in one category over another?
Yeah, sure. I guess I'll first caveat this by saying that our platform is quite large, especially on the fixed income side. And so, it's a combination of, if it's our funds that get launched, the types of screens that we might put in, or, certain upweights that we would do according to proprietary framework that I can talk through. But, when it comes to segregated client portfolios, it's really up to them what they want to mandate, right? So if they want to upweight in certain green bonds, or they want certain names screened out for tobacco or other reasons, that's sort of on them, and we'll manage effectively according to their specifications. But I would comment that on our active platform and on all sort of new ESG funds that we're launching, we're more and more employing a proprietary framework around this. And this is something that we joke around on our team what we call our pandemic baby, because this idea spurred out of the pandemic and really the frustration of RPMs around so much of the nuance and confusion around this term ESG. What can you buy? What can't you buy, right? So we have a framework that's based on externalities, or what your positive or negative output is onto the world. On one end of the spectrum is what we call positive externality securities, which tend to get upweighted in portfolios. And, within that, there are green bonds, social bonds, sustainability bonds that we would buy and, upweight and buy as much of as possible. But this also goes through an internal due diligence layer, which comes through our team as transactions get announced, as mandates get announced. We'll actually meet with issuers like Salesforce and Amber's team, for example, to understand what's in the underlying framework, what gets funded, to make sure we're comfortable, and circulate, our thoughts to the rest of the platform on sort of the green or the social side based on that transaction. And on the other end, obviously, what we call the negative externalities, or the next, it's to not buy it as much as possible. And you can think of what some of those screens might be. So, I think in the broader spectrum, that's how we think about it. But, specifically to green, social, and sustainability bonds, those do get upweighted a lot in our framework. But that has that layer of internal due diligence that we do.
Thank you. Marilyn, going back to you on the process, so we've heard Amber saying, how she's experienced, issuing the bonds internally from her perspective as an issuer. So once, the board or the management of a company has approved issuing a green bond or sustainability bonds, what are the different important steps that you usually recommend your clients to follow to ensure a successful execution of the transaction? And then, Alan, after that, I would love to hear your views on, obviously the role of the law firms on the transactions, because obviously it is a crucial role.
Sure. The good news here is that the legal side of things is the place that should not scare anyone off in terms of doing green bonds or sustainability bonds. That aspect of it is kind of, to be honest, relatively straightforward, and there's a well-worn path. So in terms of as companies think about going down this path, I think one thing to note, which may or may not have come through to date, is that if you're doing a bond, a lot of times an investment grade issuer like Salesforce might do, let's say for argument's sake, doing $5 billion worth of bonds in 5 different tranches. Not all of those tranches need be green or sustainable. In other words, you might have projects that only allow for $1 billion or $2 billion, and you can allocate by tranche we're going to take our 10 years, for example, and we're going to make our 10-year bonds apply to sustainability projects or green projects. And the other 4 bonds would not. It would all be part of the same offering. There would be a different element to the marketing part of it, where you would talk about the sustainability part and that tranche. But otherwise, it's all part of the same offering, and in many ways, no different than, a regular bond offering, or as Marilyn said, whatever type of debt instrument you plan on issuing, that's what would govern, and you'd think about that in the normal way. So in terms of planning, I think as Amber laid out for Salesforce, they are very advanced in terms of how they think about sustainability and the projects that they do. For companies that are have moved along that continuum, less so before they get to a bond, it's important early on to think about what are if you're going to do a green bond, for example, and apply it to a set of projects, what are the projects that we have going forward, and what are their time frame that fit that profile? And ensuring that, and by the way, you can go 2 years backwards as well from the time you issue a bond. So if you built a plant last year, you can use those proceeds, even though raised a year later, to apply to that. But the important part is to think about what are the projects we have or ongoing or plan to have, what is their time frame, and how can we as a management team, do we have the folks who can help us ensure that those proceeds are going to be applied to those projects? Because what the bond is going to do, it's going to lay out in your use of proceeds, using my example, let's say it's your 10-year tranche, $1 billion. The proceeds from that bond are going to be applied to the set of eligible projects that you define. And each year, you'll need to be able to report how you applied those proceeds towards that eligible project is what people commit to. And typically, an annual report says, we said what we were going to do, here's what we're going to do, now we did it. And often also describing the impact, KPI or otherwise, of that spend. The interesting thing about green bonds, and a little bit different from the linked bonds that Marilyn mentioned, which are a much smaller part of the market in the US, is that there's nothing in the governing instrument for the bonds, in other words, the indenture, which is the thing that governs the requirements for the company relative to investors. Nothing about the green bonds are in there. So it isn't like you have a covenant, which if you breach it, it's going to cause violations of, cross defaults under other agreements that people worry about. It's really a use of proceeds discussion. That doesn't mean you can't take it seriously. You have to take it seriously. And investors take it seriously, as Emily, I'm sure, can attest. And they do look at those annual reports to see, that you did what you said you were going to do, but it's not part of the governing instrument. And I think that's a pretty important feature, because some people worry that, look, if it was in the indenture and we somehow didn't get it exactly right, is somebody going to claim we defaulted under our bonds? And the answer to that is no. There is no breach of any legal covenant, legal agreement. So that's kind of how you think about it. And the lawyer's job here is largely to work with the company to make sure, one, they have the right processes to help establish what those eligible projects are, the right processes and team to manage it going forward to ensure that the money is spent on those projects and that it can be reported back out. And then in the course of the bond issuance is to ensure that the framework, and people will put in place a framework which will describe both for that bond issuance and for everything else they do in this regard, how they intend to spend money and the types of projects, making sure that matches the use of proceeds description, which is a smaller version of that, which will be in the prospectus and that investors will see. And then also finally in the roadshow deck that you will go and market the bonds, and in particular, market the green or sustainability portion, that it all links up. So there's three linkages. There's the framework, the use of proceeds, and then the marketing material that the company all want to be consistent and accurate. I think that's largely our role. Yeah.
I'll go back to the point around investor engagement, because I think that's an important point we want to discuss here. But first, Emily, just, from your perspective, obviously, you see a lot of deals, I'm sure, coming to you, right? Coming to your desk. From what you see, what is a credible sustainability strategy for BlackRock? Is there any specific KPIs or area of focus that you expect to hear from the management? And conversely, what are the sort of red flags that would sort of stop you from investing?
Yeah, totally. So I would comment on the use of proceeds type structures on the green, social, and sustainability bonds that we've been discussing, that Alan has outlined a lot of, in terms of the legal side, but a lot of that we also look for, right, as investors. So we definitely do our due diligence on it, as I mentioned. In fact, we have a shading system for how green or how social your use of proceeds are that go into the framework. So, as the issuer comes to market, when they launch their framework, when they launch the roadshow, we definitely go through the materials. We meet with the management companies, we attend their roadshows, and we'll evaluate based on the use of proceeds listed in their framework, based on the exclusions that were included, how long your refinancing is, right? Per what Marilyn and Alan both said, we want it to be within a 2-year look back. If you are doing any form of refinancing, your forward-looking commitment to make sure that the impact reporting is in place, that you're disclosing all of those details, that you'll be in the market with an allocation and impact report a year and a half down the line post issuance, right? So I think having that commitment on the outset is definitely very, very important. And then on the underlying use of proceeds, I mean, it's really across categories, but we have our own taxonomy in terms of how we classify the various use of proceeds. So closer you are to that 2-degree, zero carbon economy, the higher the shade that will get you. So, you think net zero buildings or passive house type buildings, if you're in the green building sector, that's going to get you a dark green, versus something like a LEED silver might get you a light green. Renewable energy in the forms of, wind and solar, that will be more like a dark green type of use of proceeds, versus something more along the lines of a combined heat and power or biomass with certain life cycle emissions attached. That's going to be closer to like a light to medium green, right? So we really dig through all the various use of proceeds. To the extent possible, I think it would be helpful if the issuer can disclose the current eligible asset pool, what that consists of, especially if the framework is really large. So we have an idea of the types of assets that get funded on the underlying. And I think I understand that's, tends to be a little bit more challenging on the legal side. Alan can probably comment for US issuers than it may be for European issuers, for example. But, I think on the outset, as much clarity and detail, as feasibly possible, that's useful for us, so we get that information. But yeah, I mean, that's, I think echoing a lot of what Marilyn and Alan has said, but, we do really dig in here.
Moving on to investor engagement, we touched base briefly on that before with Alan. Amber, so obviously, Salesforce is a known name in the world, but what kind of level of engagement within fixed income investors did you do before issuing the bonds? Did you, for example, a non-deal roadshow? Did you promote your framework with investors? What was your interaction beforehand?
Well, this was an area we debated quite a bit about. Well, first of all, you need to check with your counsel to make sure what you are permitted or not permitted to do. So that was the first thing that we did and understand. And then we worked with our advisor to discuss what are the pros and cons. We wanted to make sure our investors felt like they had the necessary interaction with us. In this particular issuance, it was part of a larger issuance. Therefore, ultimately, we decided not to do a non-deal roadshow, which is an issuance, which is a fixed income investor engagement ahead of issuance. Though we wanted them to have a very clear delineation of that there is a sustainability tranche in our broader issuance. So we recorded an ESG specific section in our net roadshow. And we also held a series of one-on-one calls with large ESG investors in the morning of the issuance, and also advise all of our active book runners where the link to our framework is located, so they have clear access to it. And looking back, I really remembered our conversation with BlackRock. It's great to have these fixed income investor engagement. You can hear their feedback and their questions on what are the KPIs they care about. And I was very impressed with the team and their due diligence around that. So I believe that our result was the right fixed income investor engagement for this particular issuance. And I think it could go either way.
Alan, I know there's quite a lot of obviously regulations around investor communication, especially for public companies. So what are the guidelines that you usually advise your clients around communicating before a transaction? Yeah.
So the one issue that legal issue that people do think, a legal issue that people do think about, and I will caveat this by saying there's a bit of a range of thinking amongst law firms about how best to do this, which is the question of, for a company that, let's say it's their first, sustainability or green social bond issuance, so they've not done it before, and they don't have a framework up, more generally. So this is they're putting a framework up for the first time in connection with the issuance of a bond. One of the challenges that you face is, when should that framework go up as a legal matter? Can it go up the day, let's just say for argument's sake, you're going to launch a bond on a Tuesday morning. Can the framework go up on Monday morning? Can the framework go up on the prior Friday? Or would it be better if the framework was up, 2 weeks prior? And that issue relates to whether and this is probably more technical than we need to get into, but whether that framework constitutes a free writing prospectus that should be filed with the SEC. And most people don't want to file it. If you have a framework that's up early, well before your bond issuance, that issue goes away. And you're typically, though, the framework, people have gotten more comfortable by putting the framework up late, as long as it doesn't specifically refer to a particular bond issuance. The more general the language, any bond issuance you do, any debt raising you do may cover the following broad set of principles in terms of how you might apply the proceeds. That's going to be easier to do closer in time to the time you're doing a bond issuance without filing it. And in terms of what you can do in the marketing, as Amber said, very often certainly for repeat issuers, the marketing focus, even for a larger bond offering, is focused just on the sustainability piece. And that morning when you're launching the bond offering and really only have a few hours of marketing, it's often focused on that green bond portion, the green bond tranche of your larger bond offering. And it just needs to be consistent with the disclosure that you have in use of proceeds, which in turn is consistent with the framework that you've put up.
Marilyn, I don't know if there was anything that you wanted to add, perhaps around investor engagement when advising your clients.
Yeah. So first, I'd like just to make a comment on process, because I think that for many corporates, as they venture into looking and considering a green or sustainable bond, I think the first question is, how much work is it, right? I mean, like, who do I need to engage in, and how do I get buy-in, right, from the rest of the company? Am I creating too much work, right, for ourselves? And I think that's a fair question. And what I usually advise corporates to do is to hold a meeting, right? To gather together a group, somebody from the sustainability office, somebody from treasury, someone from finance or accounting, someone from strategy, maybe someone from corporate communications, right? And then of course, someone from legal, right? To say, we're thinking about embarking upon a green bond. And it's not a lot of work, but it'll require input from each one of your teams and get buy-in at the very beginning. I think that's very important, because that way everyone feels part of the process rather than being asked to do additional work, right? And it becomes sort of a very team-oriented approach. While it is true that the large burden of work will rest upon Treasury and the Sustainability Department, nonetheless, it's important to have everybody on the same page. So that's the first thing that I would say. The second thing is to pick a structure that you're comfortable with, right? I think there's no reason to do all the work yourselves. The structures on the street have done this time and time again, and have a lot of experience. So it'll make it a much smoother process. And then the third is to take a spreadsheet, which we usually will send to corporates. We'll have the 2-year look back. It'll have going forward 2 or 3 years. It'll have every eligible project category. And you can send the same spreadsheet to a variety of business units, so that when you get it back, it's in a very organized way where you can, collect and collate all the information. A much easier exercise than just sending an email. And in my opinion, those few steps at the beginning set the tone for the entire transaction, because then you're not dealing with different spreadsheets and different ways of approaching things. Much more organized and much more efficient. Now, when we think of investors love to be part of the process, right? And in Europe, when you're doing Reg S transactions, it's always much easier to involve, investors, throughout the process. SEC registered transactions, as Alan went through very clearly, have very rigorous guidance around, and different lawyers have different interpretations of exactly what can be done. So, in the early engagement, involve your counsel as well, right? So that they can begin to formulate their opinion on the best practice they think is important. But, investors are going to want to know exactly what are you going to use the money for, what is possible, and what you think the environmental impact will be. So it'll be a year from now. But if you say it's green buildings, there's a lot of different ways to define a green building. And so investors like Emily will have their own guidance that they've created internally to define, we think LEED Platinum is how we define green. Others will use, primary energy demand. There's a variety of different ways in which you can define that. So the amount of detail and rigor around that, super helpful to the investors up front to get them super comfortable. And then they'll know what impact metrics they're going to be delivered a year from now.
Emily, when you actually have transactions, listening to what Marilyn was saying, when you have a transactions being presented to you, what is actually important for you? Do you focus on the name, the company, you want to invest in the company and the strategy, or do you actually focus on the strategy itself? What sort of matters the most for you when you make an investment decision?
Yeah, I'd say that it comes in multiple. Like, I'm one piece of the puzzle when it comes to making an investment decision, right? So all of the pieces that Marilyn mentioned, if I'm on any investor call with any issuer, you'll probably hear me asking very similar questions, and other investors in the structure as well. What are you funding? What am I going to get in terms of reporting? What are the underlying green projects that you're doing? Can you be more specific about what they are, et cetera? And that helps me in my role make the determination. But, in terms of actually investing in the credit, it's multiple, right? It's my determination or our team's determination of how green it is or how social we think it is. It's what we think about the credit as a whole, right? Whether or not the platform's actually positive on the credit, we think it's a strong buy, or, you buy at a benchmark way, or, it's actually underweight from like the fundamental perspective. And 3, it depends on the strategy. Do you need more room for green bonds or social bonds? Is there an upweight in that portfolio? That all determines sort of like whether I invest, and 2, how much the order book looks like. So those are all different aspects, and I think depending on the fund and the portfolio, that could look really, really different, right? So as you can imagine, for example, for some of our recently launched impact strategies that are, 80% green social sustainability bonds, and we have one for the EM market, that's going to a lot more heavily on sort of our team's evaluation, as well as, our EM specialists on those names, versus something that maybe just has like a 10% allocation to green bonds.
Speaking of order book, that actually leads me on to the question on pricing. The famous greenium that everyone talks about. So, obviously we know that what was there was so much demand. There is so much demand for ESG bond, that obviously that drives the pricing down for issuers, with a high level of oversubscriptions for a lot of deals. Marilyn, from your perspective, obviously being very active in arranging these deals, do you actually still see a pricing benefit for issuers in issuing a sustainability instrument?
Good question. So, that depends. If you're bringing an issuance that is, 3 billion in size, right? You may actually see less of a greenium effect, because there's enough bonds to go around. So if you have a single tranche of only 500 million, there could be, for example, a greater lack of supply, and you may wind up with something. If you have a framework that's investors might consider super dark green, it may trade with a slightly greater demand. Emily may be able to put it in more portfolios, for example. But I think the most important thing to say to corporate treasurers that are listening is that the primary reason for labeling a transaction green, social, or sustainable is not the basis point or 2 better execution that you actually might get. If that's your only primary goal, you probably shouldn't, really focus on it, because investors see through that very clearly. And as you can see, as Amber's talking about Salesforce and their mission and their passion, you can feel it, right? And you know that this transaction means a lot to them, because they want to make sure that their broad stakeholders, including their investors, is really well aware of all the initiatives and what they value. And the same is true as they recruit talent, as they retain employees, right? There's so many other aspects to a transaction than the basis point or 2 of a greenium that you may get. So, and also from a execution standpoint, there are many other factors that actually will contribute to the actual pricing. One being, how many transactions are actually coming to market that day? Are stocks up or down, right? Where's the Fed and what is the Fed community? So there are a lot of other things to consider. So when you think about the actual greenium and whether there is one, I think you just have to take it with more of a grain of salt. There is no question that investors have demand for green instruments, without a doubt. And then I'll let Emily, follow up and make her comments on that. But I think that's really important to remember, that this is a strategic transaction that investors will follow and will really want to understand your strategies. So that's what I would focus on.
Emily, any comments?
I think we definitely see through, a lot of the fluff. At least that's my job. So, I still have a job, and that's probably a good indication that we're seeing through the fluff. But yeah, I think the commitment is really important from issuers. I think just based on their eligible asset pool and how they defined it and the amount of detail they put in, is pretty indicative of the direction of travel of, how good or bad of a transaction that will be. But from the Greenium perspective, I really do think from what I've seen, it's supply demand, right? So if you have, I forget who I was looking at the other day, but there was an issuer who, I think over 80% of their financing currently and their outstanding debt is in the form of green bonds. So, in terms of like the greenium that you might actually see from that issuer, it tends to be a little less than something compared to within sector, right? But if you think about sort of their entire debt profile and all their public bond offerings, they're effectively green bonds. So there isn't really too big of a differentiation. I would say that there is still outsized demand for green bonds in the sense that, we have a lot of homes for them and a lot of strategies, in particular in the US, speaking about one of the screens that we have on a lot of portfolios is on coal revenue or like coal generation revenue. And, for those power and utility companies in the US who issue green bonds and say their general corporate purpose debt gets screened out of that screen, their green bonds will actually fly through that screen. So, it gives the investability and the exposure to that sector in certain portfolios that, you may not otherwise have since you don't have that guarantee or commitment from the issuer that, it won't go to their general coal or natural gas type operations. But that's one really, really good example, I think, of where a lot of the demand could come from in certain portfolios, just in terms of screens and what passes them and the variability, I think, really in the green and social structures that help with that uplift.
Amber, what would the sort of tangible and perhaps less tangible benefits that you saw with these transactions for the company?
Well, I completely agree with Marilyn's comment about why Salesforce decided to issue a sustainability bond. And it's definitely that it aligns with our corporate value, sustainability, and it gives us a chance to align projects that we already are working on towards a use of proceeds. And if we could encourage other corporations to embark on their sustainability journey, that to us will be, a better outcome to the stakeholders, which to us is the world we live in and the environment and social benefits. So overall, that was the primary reason for why we wanted to have a sustainability bond tranche. From what bankers tell us, of course, it broadens the investor pool. The pricing, it's very hard to tell. Again, just like Emily says, is ultimately supply and demand and the market condition you're in, and the timing and size of the tranche.
Moving on to just post-reporting then, which is sort of the last bit of the issuance process in a way. Alan, actually going back to legal. So, what are the main reporting obligations for issuers that obviously post-issuance that you see? But more like from a practical standpoint, how do you work closely with your clients to ensure that they meet these obligations?
Yeah, I mean, it's again, as I mentioned earlier, certainly in the green sustainability social bond arena, there's not, formal legal requirements in terms of reporting, but there is a commitment that companies make, effectively not a legally binding one, but one in which investors will expect to see that on an annual basis, they will report out exactly how they applied those proceeds, to what projects they applied, if any of the projects changed. Because one of the things people do need to think about is, well, what if circumstances change and a particular project that we had earmarked, we're not proceeding with, for could be any one of a variety of reasons, unrelated to the green aspect of it. We're just not going to proceed because we didn't get a permit to build a building or whatever it is. What have we then pivoted to that we're going to continue to spend that money that we had earmarked and told investors we would spend on that matches up with our framework? So one of the things you need to do, companies need to do on an annual basis, is ensure they're reporting out what they're doing, if anything has changed, and describe why that change was made, what you've pivoted to that also meets the general requirements. And then in many cases, describe, not all companies do this, but many do more and more, what's the impact, KPI or otherwise, of what you've done? What are the benefits? What has resulted from this spending on a particular project that otherwise meets your eligible project list? So that's kind of the annual reporting framework. And often it's in a broader context of companies that, certainly larger companies, are now wanting to produce an annual sustainability report, which goes even beyond, just a green bond issuance and how you applied those proceeds, to more what the company is doing and how they are evolving their sustainability approach, kind of like what Amber was alluding to earlier at Salesforce.
Amber, how do you, from an issuer perspective, how do you manage that internally? From a sort of a resource perspective.
Right. Well, we started just like how Marilyn had mentioned earlier. When we started this journey, we got together a team, and it included head of sustainability, treasury, finance, accounting, legal, our office equality, and diversity spend teams. And we started this, and you'll find that initially it was very daunting to think about all the parties that we needed to do to form this meeting. But because of the value of what you're trying to achieve, people are quite enthusiastic and open to the meeting. So that was, it could be also our corporate value that everyone's very aligned. So people were very excited about having this meeting. And from there, the same group of people, after the bond issuance, we formed a sustainable bond committee with members from each one of these teams to monitor and form internal alignment on the allocation of our use of proceeds. And, that's like to discuss the amount of green versus social spend, the amount that were previously spent versus new allocations, and to talk about, the key metrics that we wanted to track. We also wanted our proceeds to be additionally assured by an external auditor. I believe this is an extra assurance, and we really believed in that transparency and accountability. And right now we're going to be on track to issue our first annual bond use of proceeds report on the anniversary of our bond issuance coming up soon.
Thank you. So I think we've got time for one more questions before we move on to the Q&A. So actually, Marilyn, I'll ask it to you. So we know that obviously investors are pushing now for more and more sustainability instruments. I'm sure Emily will agree. And there's even, investors calling up issuers and say, hey, what are your plans to issue sustainability instruments? So when you speak to your clients, to your pool of corporates that you cover, what objections do you hear from corporate treasurers about issuing a debut issue, ESG bonds? Really, what are their main concerns?
The biggest objection that we hear usually comes from people who are afraid that it's too much work. And I will tell you, I've been doing this since the inception of the green bond market. I will tell you, there were some that were worried about the additional burden in the beginning, but I have not yet met a treasury team that regretted the extra work in doing it, looking back upon the transaction. So I think some of the Hedisons, in addition to sort of the work, some who work in isolation find it to be a harder exercise. That's why both Amber and I have talked quite clearly about gathering the team together, getting internal buy-in, right? It's important. But, years ago, when you didn't see a lot of US corporate issuance, I think there was less of a focus in the US on ESG. Well, ESG is part of almost every conversation now, that we have with corporate treasury. So I would think that reticence, of why bother is well behind us now. And Amber just has to give you comfort that it wasn't really all that much work, and that whatever work it was really worth the effort, both internally with your internal stakeholders as well as your external stakeholders. And I'll turn back to Amber.
No more excuse, Marilyn. Is that what you're saying, essentially, right?
Yeah, exactly. I mean, really, this is about, satisfying your stakeholders, right? Your investors, your internal stakeholders, right? But anyway, I'm going to leave it to Amber now.
Absolutely. It was initially when we started thinking about all the stakeholders we had to reach out to, it did sound daunting, but we started the journey early. So that would be my advice. And definitely from a corporate treasury team's perspective, I would see people in my team just working on it on their own time. I don't even need to talk to them about it. It's really a natural employee motivation and value alignment. And I agree with Marilyn. After all the hard work, with hard work, you have a team bonding experience and you appreciate the results. It was a very rewarding experience for us as a team.
Great. So we're going to have to wrap up because we have one question set out to the panelists. Hi, I have a question for the panelists regarding the rigor of the frameworks regarding labeled thematic bonds. The US is known for lagging behind in the green, social, sustainability bond market, especially in comparison to Europe. And quite often methods or systems are quoted as a justification for their internal labeling of green or social without much transparency. Would the panelists elaborate on what standards do they follow, such as ICMA, Green Bond Principles or CBI certified, to label their investment as green or sustainability? What kind of impact reporting standards do they follow and uphold? Sean, maybe that one's for you.
No, I think it's for everyone. I mean, the Green Bond Principles are the primary, the dominant standards for reporting and transparency globally in every jurisdiction, including the US. I think it's simple in a way. And of course, the spin-off, the sustainability guidance, the social guidance, and so on. And this has been an incredibly important issue, which Marilyn, by the way, has been critical to developing and growing over the years. In the climate bond certification, we incorporate those green bond bonds and we add on definitional work, green taxonomy, it's now called in Europe. But that's it really. But, I think the Green Bond Principles is where everyone looks, and that's where the regulators we speak to are looking as well around the world. They're using that as a benchmark, as a starting point, and maybe beyond flourish for a local environment. But essentially, there is a standardization that's been created in the market, and it's fantastic.
One thing I'll add about, Sean, to your comment about the Green Bond Principles, and I'm not too sure everybody is aware of this, there is a membership, if you will, so people can participate, reach out to ICMA, and as the secretary, you can actually join if you want to participate. The executive committee is made up of equal representation of issuers, underwriters, and investors. So it is designed to be broad and it's designed to be inclusive. Anybody can run for office. So just become a member. So, the reason why I like to say that is, it is the market that is making the decision. They're not waiting for someone to regulate them and tell them how to be diligent and tell them how to be rigorous. That is something that the executive committee and the broader membership actually decide and push.
Any more comments on this before we wrap up?
Well, I would just add at Salesforce, we did wanted our sustainability bond to be very transparent and accountable. So we did seek out additional advisors that, is not always necessary for a sustainability bond issuance, such as getting that second party opinion and having your use of proceeds audited. And we did both of those to ensure that.
Well, thank you very much. That was super helpful. And I think, going back to Marilyn's point, I think no more excuses is the message for today. Before we wrap up, I wanted to ask each of you, your one takeaway, your sort of one advice to corporate treasurers who are yet to embark onto that journey on the capital markets. What would be your one takeaway? Starting with you, Amber.
I've already said it earlier, so it's definitely to start the journey early and get to know your head of sustainability at your company.
Marilyn, from you?
So I would say communication, internal communication and coordination are best, and getting early buy-in from all the participants internally that you need.
Emily, BlackRock perspective.
Yeah, if you get on the train early, that helps us. So the earlier we know, the better. Gives us time to.
Alan.
Yeah, look, not to echo again, but early matters on the legal side too, so you can think about what the legal issues might be. And I would add that the other things I would think about are to be inclusive within the organization and holistic about how you think about all of the things you're doing, so that a green bond isn't in isolation from a broader, sustainability or green or whatever it is, social framework that the company is thinking about, because that's how people get excited and get bought into a larger strategy.
And Sean, you've heard the panelists, right? So what would be your word, your final word?
Well, first, 5 out of 5 for all of them. They're great. What can I say? I promise a scorecard. I'm going to say the thing to understand when you look at this particular market, capital with purpose is here to stay. Capital with purpose is here. We can have our cake and eat it too. Can you believe that? Who would have thought that we can invest to create a better world and we can actually get better returns? One of the things underpinning the pricing conversation that needs to be brought out is in the secondary market, these things perform better as a rule. They're a value product and they're a value retention product. Emily's boss, Larry Fink, once said that he made money not by giving people yield, but by making sure they didn't lose their money. Well, if you want a product that is better at ensuring you don't lose money, it's a green and sustainable bond. It performs fantastically. In other words, it performs better than the other stuff. Every time there's a tweet by some unnamed US politician, boom, market goes like that, green bonds hold their value. They stay liquid in crises, etc. And that's driving the underlying value issue, which is essentially saying, if you do something which signals to the world that you're contributing to what's got to be done and giving a return, if you can do both, it is an extraordinary winning performance. And that's why in Europe, which is, as a couple of people said, a little bit ahead of the US, in November, 40% of all corporate bonds issued were ESG themed. This year, so far in quarter one, 70% of all, just to give you an example, real estate benchmark bonds were green or social or sustainable. It's like overwhelming the market. And the sovereign growth, basically sovereign green bonds in Europe are growing as fast as they can find things to finance with them. It is fantastic. We're at 3 trillion now. When Marilyn and I first started talking about this some years ago, we're about 30 billion. This is an extraordinary rate of growth. And we'll see a growth this year of about between 50 and possibly up to 70% in the market. That's not bad for a market that's no longer a couple of billion. It's a few trillion. So it is very much something that is happening on the back of a really strong story that we are contributing while giving returns. We are not sacrificing returns to give. We are doing both. And let's face it, in the world we're going into, it makes sense. These bonds have been used as guidance for risk. If you're doing something to mitigate the risk of going forward, you can issue a green bond. You're signaling to the world and to investors that you're doing something you are likely, nothing certain in life, but you are likely to be less at risk of being clobbered by the changes that are coming through. Because those changes are coming through. Everyone is now certain of that. And that's the new world we're in. It's cool. If you can play, it's a very fun place to play, as you've heard today from Amber, as you've heard from Emily. It's really cool, and it excites the troops too, which is like collateral benefit, Amber, isn't it? But it is really nice that, you know, I've had senior bankers, some of Marilyn's colleagues, usually men, the women understand this early, is that who say for the first time in their lives, they've gone home and the kids have been interested in their work. Kind of sums it up, doesn't it?
It's cool to play, and we know that the process is actually fairly simple. So hopefully we'll see more flow of capital from corporates. Thank you very much. I think that was, you know, super interesting conversation. Unfortunately, we're out of time, but you know, thank you for your time and for your participation. And I look forward to continuing connecting with all of you. Have a great day, everyone.
Thanks for having us.
Thanks for joining.